Pleasure to be here today, guys. I am Thomas DeLello, head trader and founder at OrderFlowEdge.com. I want to welcome everyone. I want to thank Dan and everybody at Winvesting for having us here today. I'm pumped up to be here. And, you know, what I want to try to do today is share my market perspective with you, one that's based solely on order flow and supply and demand principles, maybe get you to think in some new directions about the market along the way here today. I've been in the market since 1996, so I've been around the block a few times. I'll spare you the gory details, but you know, I long became an expert in what didn't work before I came across thinking about the markets in terms of where value is in the market, thinking in terms of supply and demand and order flow. And over the course of my trading career, I've talked to a lot of people about trading, people from all different walks of life, different levels of success. I've talked to elite traders who trade profitably, and I've talked to a whole lot of regular traders who, let's face it, consistently lose in the markets. And over time, I came to the realization that elite traders, you know, what are we talking about? The 5% of traders who are consistently profitable in the market, they talk and think differently, 100% different. Elite traders talk about this, everyone else talks about that. It's almost like we're playing a completely different game, but we're not. We're all trading the same markets, we're all playing the same game. The elite traders just understand things differently from everyone else, and they work really hard too. They had to in order to get where they are in their career. But my goal with OFE has always been to do whatever I could to bridge the gap between what the independent retail trader is taught and how he thinks about the market and what the professionals actually think and do in the market. So hopefully I'm going to accomplish some of that here today. In my opinion, what most traders need is a new perspective on the markets and how they perceive market activity. And here's the thing, and hopefully you come upon this realization that a change in your market perspective can make a huge difference in your trading. Right? So I'm here today to help you guys. Any questions you have about order flow, anything you want clarified or explained about supply and demand, please ask. I want this to be as interactive as possible. I'm going to jump back and forth a little bit between my live screens here and a slideshow. I kind of have a disdain for using slides and using slide presentations. I'm at home on real charts. But I think it makes it a little bit more organized, and I'm going to explain exactly what we're looking at here. I'm going to explain some of our perspectives on order flow concepts. We'll take it one step at a time. We have about roughly an hour or so here, so you know we're not going to get deeply into stuff, but I think I'll be able to open your eyes to some interesting things. Maybe you'll hear things about the market terms that you never heard today. So any questions along the way, don't hesitate to ask. We employ a different kind of thinking, a different perspective that focuses on order flow imbalances that come into the market between buying pressure and selling pressure, particularly when this happens against levels of dynamic supply and demand, all of which in turn equates to opportunity for us. And we're gonna really point this out step by step. The kind of edge that we work with is the kind that elite traders employ day in and day out. This stuff is so insanely valuable. It works, and it still blows me away that so many traders really are operating blindly without understanding how to read order flow. And there's really a simple elegance in the way that I've traded for quite a while, and in how we're trading today, how we create our frame of reference and use it to spot opportunity. One of the biggest differences in my trading, which we're going to go into today, is my order flow concepts and principles haven't changed. The big difference for me with this dashboard that you see here is that we've automated a lot of the order flow information. And there's a reason for that. The main reason is to enable us, I should say, to make quicker, effective decisions in the market because of who we're up against. You know, the HFTs, the computers, right? We'll get a little bit deeper into that, but we're thinking in terms of who's in control, buyers or sellers, and when is that control shifting? That's the main thing, because let's face it, we want to trade in the direction of whoever's in control, right? Who's doing a better job of moving the market, right? Knowing where buyers have to prove themselves, knowing where sellers have to prove themselves. thinking in terms of trapped traders, you know, the trapped buyers that came in up here, the trapped sellers that came in down here, and what happens to them and how they get out of their positions and how that affects the market, because that's really what really truly drives price, the stops that are getting hit in the market, right? Essentially, we boil trading down to a few fairly simple concepts, and they're simple concepts because they're based on logic. They're based on the order flow information that the market's giving us. We make it logical, and when you think in logical terms, you can't help but make it simple to understand. Right? People turn, and this is really an issue for a lot of traders that I speak to, and again, I speak to a lot of traders, and I've spoken to a lot of traders over the course of my career. One of the main issues that traders have is people tend to turn the trading process into a real complicated, really unnecessarily complicated process, and it really doesn't have to be. As long as you're looking at the right information, the order flow data that's actually driving price, and you have an effective way to organize and analyze that data on your screen, trading can become a pretty simple process when you understand where and when you should be trading and when you should be on the sidelines. So I'm going to show you how we turn the trading process from something that seems complicated on the surface into something that really is pretty simple to understand by using logical concepts and tools to break down and process the order flow information that the market's giving us. We have two types of main trade classifications, and we're going to review them deeper in a little bit. But everything really stems from these two types of trades. We have what we call an inside-out trade, which is considered to be with the trend. Right? So in other words, right now the trend is down, and we're going to explain all these tools. They're very simple, and listen, I know, I get it. You're looking at my screen. You've probably never seen my screen before unless you're familiar with us at OrderFlowEdge and you've been in one of our webinars. The information here is very basic. You're looking at a few different tools. There's a few different pieces, moving pieces to the machine, so to speak, but nothing on its own is complicated. They're all very simple and very logical to understand. So we're going to explain them piece by piece. But essentially what we're doing with these inside-out types of trades, and this is the type of trade that we're going to focus on today, it's considered to be with the trend. So right now we have a downtrend. So for instance, here at 8:30 we had a push up into the inside of the range, looking for a trade on the inside of the range, back out towards the outside of the range. That's inside out. That's with the trend. So the trend is down. We're looking to be a seller on upticks. We're looking for a stop run to come back in to take price down towards the bottom end of the range. That's inside out. Outside in is the other type of trade that we take. A little bit more, I don't want to say aggressive, but it's a little bit more complex. You have to be able to process additional layers of information. It's all the same information, but you really have to look at information on a few different time frames for these outside in types of trades. Outside in are trades that are considered to be against the range. And these principles I'm going to be speaking about today here, guys, I'm, for the most part, a futures trader. I trade Forex on higher time frames. I trade some equity options on higher time frames. But for my day trading purposes, I trade the futures market. But when we're talking in terms of supply and demand and order flow, everything that we're going to be talking about here is applicable to any market because all markets are based on supply and demand principles, right? So the outside in type of trade is one that is considered to be against the trend, right? So we have inside out, which is with the trend, right? Being a seller here for moves back down towards the edge of the range. Outside in this situation here would be looking to be a buyer at the outside of the range, right, down here because the trend is down, for a move back into the middle of the range. That's outside in against the trend. So we teach both types of trade classifications, but we recommend the inside out types of trades. The inside out is, in my opinion, probably a little bit of a higher probability situation. It's more conservative. It's a little bit easier to understand. It's a little bit more clear-cut. It's a little bit easier to manage your risk. It's from all different angles. I find that most people that have difficulty trading, there's a lot of different reasons, but one of the reasons is that they tend to trade counter-trend, and they tend to step in front of a falling knife or a runaway freight train or whatever you want to call it, and they find it hard to manage their risk, or worse yet, they add into a position as it's going against them. Right? So those are definitely big mistakes. But with these higher probability inside-out trades, and this is what we're going to focus on today. So I'm kind of circling everything here, and then I'm going to go back in and we're going to talk specifics. with these higher probability inside-out trades that we're looking to go with the trend, our basic goal in setting up trading opportunity is to align ourselves with the flow of orders on the higher time frame. So right now we're picking up on the fact that sellers are in control on the higher time frame. We want to align ourselves with that flow of orders to the sell side, right? That's the path of least resistance. That's the smart money order flow, or the order flow trend as we call it, right? So right now that's to the sell side. And what we do is we use the minor HFT-driven stop runs that come in, mainly HFT and machine-driven stop runs that come in against that main trend, right? Because the trend is down. Here we have a move that comes in against the trend because, you know, we have all these ebbs and flows in the market, right, on every single time frame. These ebbs and flows that are coming in, they come in based on the stops that are getting hit. So every move in the market is a stop run, right? And we're going to talk a lot about stops today. And I know most people don't even think about something like stops besides the fact of, you know, I just got into a trade, where did I put my stop? And then, oops, they stopped me out again. We're gonna go deeper into stops, and this is something we talk about every single day in our trade room, because stops getting hit is what drives price, right? Traders getting trapped, right? And you know, I want to be careful here. I don't want to delve into too many things because I don't want to give the impression on any level that this is confusing, because it's not. But again, anything that you hear for the first time it could tend to be confusing, especially if you have too much information to absorb. So the way that I teach, you know, we have workshops, we have trade room, we have training videos. I like to break things down in terms of concepts. You learn the concepts individually, you learn the tools that we use individually, and then you start to learn how to put everything together. But when you break things down, it's a lot easier to disseminate and absorb the information, right? So these minor stop runs that come in, let me use this chart here. It might be a little bit easier because we're kind of missing the bottom edge here. So yeah, we have trap sellers that come in here. Even though the trend is down, anybody that sold here, they sold at horrible trade location, right? They sold as the market was making a new swing low here. They sold into wholesale pricing levels. And what happens is the HFTs, the Algos, they pick up on the fact that, hey, these guys are trapped. There's no more sellers coming in. We could see in the order flow here, and we're gonna go a little bit deeper into this, but we have clues here. We could see that this selling is actually diminishing. We have a reference point here for exhaustion. So this would even be an outside-in type of trade situation, but we're not talking in terms of counter trend here. We're talking in terms of trend. So these trap sellers here wind up coming back in and buying their positions back, right? It's their buying that forces the market back up here. This move here is this move here, right? We're using that move to align ourselves in proper trade location to get on board for the next move that comes back in the direction of the trend, right? Very simple and uncomplicated. If anybody doesn't understand that, please ask. It's very simple, and I'm gonna use some slides to really break this down. But I wanted to give you just a little bit of a flavor of what my charts look like before we hop to the slides. Today, what I'm going to do is there's three main steps in setting ourselves up for this type of trade. Today, I'm going to share with you the three main steps that we use, the three keys really to unlock profitable trading opportunities that we use in our decision-making process every single day in regards to trading with the order flow trend. Right? So one other thing I want to mention, yeah, Bob, absolutely. The big question is to know where the buying will stop to go short. Absolutely, and that's the key, right? But remember, and it's probably a little bit more information I wanted to give you right here at this stage right now, but here's the thing, here's the advantage. It's like you're using these higher time frame traders, you're using the structure of the market as an ally. Now think about this. If this move, you know what, let me shrink this down just a little bit here so we can see what I'm talking about here. Be a little bit easier to see. Now, if this move that comes in against the trend, and we can see the trend is down, and we're going to explain this, how we know this and what this means, but the trend is down, the higher time frame traders are aggressive to the sell side, right? So stick with me for a second here. They start to pick up on the fact that these guys down here, they sold in horrible trade location. There's really not much more in the way of selling coming in here, because you have to think about the smart money traders. They didn't just wake up all of a sudden this morning and say, oh my God, the market's breaking 2052, let me be a seller here. Where did they sell? They sold up here. They sold up here yesterday. They sold up here on this uptick. They're selling the upticks into retail pricing levels, right? They're not looking to sell breakouts to the downside unless something's changed.
Yes, 4-hour alert.
Sorry, unless news has come out or something's changed in the market. They're looking to sell in retail pricing levels, right? So the only people selling right here are, number one, longs that are getting stopped out, and number two, retail traders who are selling new lows. You know, the market's selling off, they can't take it anymore, the market's moving to the sell side, I don't want to miss this move, let me be a seller, right? So once those sellers come in here, there's no more selling coming in at these lows. The smart money picks up on the fact these guys are trapped, the HFTs, the Algos. They come in and they start to buy against these guys down here at these lows. They're buying as these guys are selling. Now what happens is as soon as the market starts to uptick, anybody that's sold in here starts to get nervous. You know the feeling, right? You just sold a low and all of a sudden the market stops. You're like turning around looking for the cavalry. There's no more selling coming in and you're like, oops, I did it again. I just sold the low and here comes buying coming in. Now what are you forced to do? You're forced to buy them back. Right? Either your stop gets hit or you throw in the towel and you say, all right, I can't take this pain anymore, this heat, I'm going to buy it back. That buying is what forces the market up to retail levels here. And we're going to explain how we know this is proper trade location. But suffice it to say right now, this is proper trade location. So these stops from these guys getting stopped out brings the market up to this level. Now think about this. Now hopefully you stuck with me. If these guys here are aggressive to the sell side on the higher time frame, not only are they not buying in here, they're probably sitting up here waiting to be a seller with you, right? So you're kind of leaning on that. You're leaning on the fact that, hey, these smart money traders, they know where value is, we know where value is, and we're expecting them to be here looking to sell. Now, if they're not and things change, and that happens, the trend can change, something's changed, maybe news comes out, that's a different story. You know, if that happens, that's information that things are different and maybe we don't want to be a seller here. But what we're leaning on is what we expect to happen most of the time. Right? We're leaning on probabilities. That's all we can do. We don't have a crystal ball. We don't know for sure what's going to happen. I don't know where the market's going to be 5 minutes from now. I don't know where it's going to be at 4:15 today. Nobody does. Right? We're not looking to make predictions like that. What we're trying to do is set ourselves up in situations that we're familiar with. We understand the underlying conditions, we understand the context, the patterns, the clues that we're seeing, and we use that to build cause to take a trade based on probabilities. That if we see this situation 100 times, 70 times we're going to see the market sell off. You know, maybe 30 times out of 100 the market's not going to sell off and we're going to stop ourselves out with a small loss. That's fine. That's part of trading. It's not a big deal. So we're going to get back to that. And again, hopefully that wasn't confusing. It really isn't, guys. When some of this stuff, I mean, I've had some of the biggest aha moments in my career when I started to really learn about, I mean, order flow in general, of course, but specifically these stop runs, where they're occurring, how I can identify when they're ending and the exhaustion that is setting up and how that leads to opportunity. So hopefully you'll have a couple aha moments here today. But you know, my work with order flow data and order flow based strategies, you know, probably a good 10 years now that I've been involved with order flow. It's never stopped. It really hasn't changed. It's been one of constant progress and development over many years, but I don't jump around from one market strategy to the next. I found what works and I stuck with it. And nothing has changed as far as our order flow perspective, the way that we think about the markets, the concepts we've always used. We still use them because they work. The main improvement that we've made is that we've automated things to make it easier for us to make decisions. So all these things that you see here on my screen, this little triangle that popped up here, these TT lines, the way the bars are colored based on who's in control, sellers or buyers, the delta force numbers, these are all the automated order flow tools that we've created and put onto our dashboard to help us make quicker decisions. That's what it comes down to. So that's what we're going to break down here. So we're going to do something different here today, guys. We're going to, you know, I'm going to do what I can to cut out the fluff, and hopefully I'm doing a good job so far. There's no sales pitch here today. If what we talk about here today, and let me just get my slides back up here. We're going to jump to the slides here now, and maybe things will seem a little bit more clearer and concise. Okay, there we go. If what we talk about here today, and understand that we're just going to be scraping the surface here today, but if we talk about here today resonates with you, we're going to be holding an open trade room tomorrow morning. I'd like to invite you to join us, That's the link right there, orderflowedge.com/open-room. Worst case scenario, you can't find the link or whatever, you just email us at support@orderflowedge.com. We'll get an invitation out to you. Just request the invite in the email, and we'll be sure to get the link for you tomorrow. And what we're going to be doing tomorrow is going into this stuff more in depth. We'll be able to look at the live markets more. We'll show you some trades if there's opportunity setting up. We're going to show you the information that we use in order to trade, the order flow information coming from the market. Now, somebody asked about order flow before. Great question, because, hey, listen, we're talking about order flow here today, so let's get some basic definitions out of the way, and then we'll get back to the dashboard and kind of explain the tools that we're looking at. What is order flow? Because actually a couple of you people asked before. When we say order flow, what we're referring to are the buyers and sellers coming into the market. It's at the very core level. Order flow is the real-time supply and demand caused by all the buyers and sellers. That's it, guys. The buyers and the sellers coming into the market. It's the collective actions of all the traders entering the market that creates this flow of orders. Order flow is what drives price. Think of order flow as the fuel that drives price, kind of like how gasoline is the fuel that drives your car, right? Now, here's a mistake that a lot of traders make, and I did this too right off the bat because everybody told me to do this. What did I used to do, and what do you guys probably do? You look at price or some derivative of price to try and get a clue on what price is going to do next. And let me give you a little bit of an analogy. Looking at price and to try and determine and help you determine what price is going to do next is kind of like looking at your car engine, staring at your car engine to try and determine how much longer that car engine is going to run. That's not going to work, right? What do? You look at the gas gauge to see how much gas you have left. It's the same thing with order flow and price. We're not looking at price to try and determine some pattern based on price or what price is doing. You know, price is making a new low, so now it has to keep going lower, or it's making a new low, so now it has to turn around. There's no information there for me. What I'm looking at is the fuel that's driving price, and that's the order flow. So it's kind of like our dashboard. It's kind of like this big fuel gauge, if you will. But simply put, order flow is what drives price, and that's why we follow the order flow. Change in order flow precedes change in price, right? Same thing with the gasoline, right? Changes in the level of your gasoline is going to change your engine, right? Basically, whether it's going to run or not. Right? If the gasoline gets down to a certain level, goes empty, boom, your engine's not running anymore. Same thing with the order flow. If the order flow that's driving a price move suddenly dissipates, exhausts, or changes direction, guess what? That price move in that direction, that was heading in that direction, is probably, and all I can say is probably, because there's no absolutes in the market, it's probably going to change direction as well. So we follow the order flow, and it leads us to opportunity. The other reason why we follow the order flow is because the smart money follows the order flow. The HFTs, the Algos, the trading programs follow the order flow. When I talk about an HFT, guys, I probably in this day and age, most people are familiar with what HFTs are, with all the press that they've been getting in the past year or so. We're talking about high-frequency trading programs, computerized trading programs, right? Computerized trading programs that are programmed to trade based on, you know, basic specific conditions that they pick up on. But the algos, the thing that they do is they trade real quick and they trade a lot of size, right? So those are basically our main competitors in the day trading time frame. But I lump them all into smart money because any trader or trading entity that consistently makes money, I'm going to call a smart money trader. I don't care if you're trading a 1 lot or you know, 2,000 lots. If you are profitable, you're a smart money trader. That's the reason why we follow the order flow, because all these other traders are following the order flow. And listen, don't just take it from me. I've read numerous papers and studies about these HFTs and these algos over the course of the last 2 years. I've made it kind of a little personal journey of mine because I've seen how the markets have changed in the last few years. I know that they're there. I know that they're a big part of the trading arena. So I know that it's important as a trader. This is my business. I want to know who's in the market with me. Who am I doing business with or against? Very important. So I've read a lot of research papers. This is one paper. Here's a quote from a paper done at Harvard in early 2013. This guy, Brogard, that did the study from Harvard, and we have links to these studies. If anybody wants them, don't hesitate to email me, and we'll send you some links. It's pretty interesting reading if you're interested in learning about the market. This guy sampled 26 of the biggest HFTs at the time, and he found that their strategies were consistent with the strategy based on order imbalance-driven price reversals, right? So, listen, I already knew this, but that's kind of proof right there that we're onto the right information, because if these guys who spend millions and millions of dollars building these algos, collating themselves at the exchanges and building these infrastructures that enable them to trade with these HFTs, if they're trading based on order imbalance-driven price reversals, then I think we're onto something. So the question becomes, yeah, Bob, we're going to discuss how to trade the Cum Delta 2 a little bit. We'll go into that much deeper tomorrow, but I'm sure you saw it on my screens. Big part of what I do is looking at the cumulative delta, and basically, to me, that represents inventory coming in and out of the market, which, again, represents stops. It's all about the stops getting hit, and cumulative delta allows you to see when the stop runs are coming and where you can expect them to exhaust. And I'll show you stuff live, and I'll show you a lot of examples of that. It's so interesting to think about the market in these terms, because this is what drives the market. What trading platform? Well, the charting platform that I use, and I'll answer some questions here as I go, and if I miss anything, I'll come back and we'll swing around and we'll get them at the end. The trading platform, I use different trading platforms. I use OEC. I use Sierra Charts for charting. I also trade through Sierra Charts on a couple of the platforms, Infinity. There's a couple different brokers, and I'm a big advocate of, once you start building up account size, I'm an advocate of kind of spreading it around a little bit and use a couple different brokers if you can. This way, if one broker has an issue, you still have your ability to trade in another account through another broker. But if you need recommendations for trading brokers, don't hesitate to email us. We have a couple that would help you get set up and even help you use Sierra, get you set up on Sierra Charts if you'd like to do that as well. So how do we join the algos and the bots? We do this by programming our own algos, right? How else can we do it? If they are looking at the order flow and they're trading in microsecond time frame and they're trading very quick, they're in and out of the market constantly and consistently throughout the day, how do we join them in what they're doing? We have to make our trading decisions quicker, right? So we do that by programming our own algos. Now, let me just back up a second here, guys. When we're talking about smart money traders, we're talking about the algos and the bots. It's very important to understand that we're looking to join them, meaning, listen, I'm not going to be trading 1,000 lots, I don't think, anytime soon. I'm not trading in sub-second time frame, and I don't need to do that. We join them by trading in the same areas that they're trading. We join them by looking at the same basic rudimentary information that they're looking at. We trade alongside them. So are we competing with them in a sense? Yeah, we're competing with them on fills, for fills, right? If they're looking to sell the market as it upticks into 2054 and we're looking to sell the market there and there's a bunch of other smart money traders, yeah, we're competing with them to get filled, but we're not looking to go against them. So in other words, if they're selling, I don't want to be a buyer. If they're buying, I don't want to be a seller. I don't want to be doing what they're doing. I don't want to go up against them. So we do this by programming our own algos. And these algos, they really tell us three main things. And these are the three main steps that we're going to go a little bit deeper into. Number one, they tell us what trade direction we want to trade in, right? And these are the algos and the studies that we programmed. Number two, they show us where ideal trade location is. Number three, they give us the real-time order flow confirmation that we're looking for, right? So for instance, if price is rallying, right, and we could see that the trend is down, right, so that's our bias down, we know where ideal trade location is going to be up over here, so that's ideal trade location. So what are we looking for when the market gets up here? Well, we can look for confirmation in the order flow, right? Confirmation that's telling us, hey, this temporary stop run that's coming in against the main trend is exhausting. So what are we looking for? We're looking for two basic main pieces of information, right? If we want to be a seller here, and ideally if we're selling, our goal is for the market to go back down, right? So we want to look for two main clues here. Number one, we want to look for the buying that got the market up to this level. We want to start to see that buying diminish, right? The other clue that we want to look for up here is evidence of sellers stepping in, right? What two better clues could you expect to see or want to see in this situation, right? There are no better clues that I'd want to see. Right, so that's the real-time order flow confirmation, and we'll show you exactly what that looks like. When all that comes together, that's the sweet spot. That's what we call pocket aces. For anybody familiar with poker, pocket aces is the best possible starting hand in no limit hold'em that you could possibly get. It's not guaranteed to win, but let me tell you something. If you're dealt pocket aces pre-flop and you're playing no limit hold'em, you wouldn't mind pushing all your chips into the middle every single time, because that's the best starting hand. And you're going to lose some hands. You know, you're going to get someone calling you with a horrible hand, and they're going to get lucky. It happens. You know, listen, slot machines have to pay off every once in a while, and that's what keeps the people coming back. It's the same thing with losing traders. They get paid off once in a while. You know, it's more a matter of them getting lucky, doing the wrong thing in the right place at the right time, and they wind up getting lucky and they get a winning trade once in a while, and that's what keeps them coming back. And again, I speak from experience. I've been there. But that's the sweet spot. That's when everything comes together for our edge, right? So, you know, let me talk about stops for a second, guys. It's all about the stops getting run. Make no mistake about it. It's always been like that. It was like that 100 years ago when you talk in terms of Wyckoff, Richard Wyckoff, and Jesse Livermore. They talked in terms of the composite operator and the smart money operators in the market and how they kind of manipulated price. It's the same thing today. It's about the stops getting run. That's what drives the market, the smart money traders. The main difference today is the HFTs and the Algos, and how quickly they run the stops and how frequently they run the stops, right? They feed on the stops. Really, the smart money, the market makers that are running the stops, and all the majority of the other traders, they feed on the stops. The rules from their perspective is confusion. They want to leave no discernible direction for other traders to pick up on. They want to trick people into getting into false moves, right? So think about this for a second. In that scenario that I gave you before, where we had trapped sellers down here and this was ideal trade location, what do they have to do to get the market up here into an area where they want to be a seller? They have to make it look like it's a good idea to be a buyer, right? They want to get everybody coming in here to be a buyer. That's going to get the market up into an area that represents value to them, and they're going to come in as sellers, right? When they want to be a buyer down here, what do? They make it look like it's a good idea for everybody to be a buyer. I mean, to be a seller, right? They need supply if they want to come in here to the buy side. And they come into the buy side and they run all the stops on all these guys down here. It's the same program that runs over and over and over again. Every single move in the market, whether we're talking about a little move of a few ticks, trapped buyers, trapped sellers, trapped buyers, trapped sellers. And as these trapped traders have to come back in and their stops get hit and they have to liquidate their positions, that's what moves the market. Boom. These trapped longs sell. Now they have other traders that sell here to get short. Those sellers get trapped. Their buying brings the market, and so on and so forth. Very uncomplicated, right? Very basic. But that's what they need to do in order to get the market into areas that they want to conduct business in. Right? Every move in the market is traders getting trapped, stops getting hit. Those stops getting exhausted, price turning around and heading in the opposite direction to hit stops, or stops getting hit in the other direction. Now, it's just a cycle that repeats over and over and over again. It's very easy for them to fool the majority of traders because of the inaccurate perceptions and perspective about the market that most traders have. Right? Most traders aren't thinking in terms of value when it comes to the market. Right? It's been like that forever. You know, like I said, Wyckoff and Livermore spoke about this type of stuff 100 years ago. And the main difference, and again, this is why I've automated in recent years, especially after 07 and 08, I started to see the landscape of the markets change drastically. And this whole evolution with these HFTs coming in, right? And that's why we've automated this information. So this is our dashboard. And with our dashboard here, it's just simply a framework that we've built around the vital order flow data that the market's giving us. And we do this in order to better organize things in an automated fashion across several different time frames. This is the S&P futures. Now, we use this dashboard on any single market that we want to. Any futures market, CL, gold, 6E, you name it, we can trade it, and we have traded it. And I'll show you examples of a few different dashboards when we go back to the live screens. And tomorrow, if you join us in the live room, we'll show you other markets too. You could trade equities, you could trade Forex, whatever the case may be. What I like to do is use a variation of different time frames here so I get a good view of what's happening across this broad spectrum of different time frames. So here we have a 2 range, we have a 4 range, we have an 8 range, we have a 16 range. These are just the time frames. So in other words, 2 ticks of range and a new bar forms. Here, 4 ticks of range, which is 1 point in the S&Ps, a new bar forms. Here, 8 ticks of range, a new bar forms. Here, 16 ticks of range. So you can see here we're looking at the last couple days. Here we're looking at the last, maybe 24 hours. Here we're looking at the last couple hours. Here we're looking at the last few minutes. So what we're trying to do is align ourselves with what's happening over here and then look for the clues to enter over here, right? Pretty simple. Now, our dashboard, behind the scenes, what this dashboard is doing, the information that it's processing, it's very complex and robust. It's crunching and processing a lot of information, a lot of data, but for us everyday traders, it's simple to follow on the surface, and it really simplifies the order flow information in every way. Everything that it's doing I could do on my own, but when it comes down to it, it does it a lot quicker for me. So I don't have to stop and make calculations. I don't have to stop and form zones. I used to form my zones by hand, these areas of supply and demand. Now it's done automatically and it's done ahead of time. So I know ahead of time. This is all hearsay to you, but at the close yesterday, I don't know if there's any of our members here today, we pointed out the areas to look to be short for a swing trade to the sell side into the 60s. I'll show you that in a second too. In fact, I haven't even been in the members room here today. Hopefully some of our members put on shorts yesterday to the short side. But the point is that it lets you see ahead of time where the areas are, that it makes sense to conduct business. If I'm looking to be a seller, I know ahead of time where I want to look to be a seller. If I want to be a buyer, I know ahead of time, usually way ahead of time, where it makes sense to be a buyer. That's a beautiful thing. So let's talk about the tools that we have on the dashboard here one by one, and then I'm going to show you our main setup, and then we'll get back to the main screens here. First tool we have are the TT lines. And the TT lines are really the heart and soul of our dashboard. The TT lines are showing us where dynamic supply and dynamic demand are. Right? These TTs, they represent inflection points in the market, areas of value where a strong driving force is going to be needed to continue beyond these levels. Otherwise, price has a very high probability of reacting back into the range. Right? These are created using a proprietary combination of supply and demand and order flow data. And what we're left with here, guys, are accurate references where the smart money identifies where wholesale and retail value are relative to the time frame that we're looking at them on. All right, so very important information here. One of the most important things you're going to hear from here today. Why the market moves into certain areas. It's about a pursuit of value for smart money traders. The pursuit of value is the primary source of market movement, right? Stops get the market into value for smart money traders. So in other words, like I pointed out before, if they're looking at this area as value, they need stops. They need to use stops to get the market into the area where they want to look to trade, right? They're looking at this trading business way differently than most traders are. Most traders are coming in, they're using some random price-based system to trade. They have no idea where value is. They're not thinking in terms of value. But meanwhile, in your everyday life, all of your transactions that you make, you have some reference for value, right? Whether you're buying a house, you get an appraisal so you don't overpay. If you're buying a car, you're going to do research on the internet so you know what you should pay. If you're buying a jar of peanut butter in the supermarket and they're charging $16 for the jar of peanut butter, you can say, you're crazy. I can go down the block and get it for $4 a jar, right? Because you have a sense of where value is for these products. But for some reason, when it comes to the market, people come in, they want to conduct business in the market. They have no idea what value is in the market, right? Meanwhile, you can't tell me one business in the world that's based on wholesale and retail inventory that doesn't run based on value, right? It's impossible to create profits if you're consistently buying high and hoping to sell higher, or selling low and consistently looking to buy it back at a lower price. Very hard to conduct business that way, right? So this is the way the smart money looks to trade. They're thinking in terms of where value is in the market. RTT lines do an effective job of showing us where value is ahead of time. So we know where they're looking to trade, and we're looking to trade alongside them, right? That's what it comes down to. The TT lines are also representing areas where, and this all kind of comes together, right? If you think about it, that if we're looking to be a seller here, the trend is down, and we have this area identified ahead of time. The market comes up into this area, and all of a sudden, boom, we get short, we see clues to get short, and now the market starts to continue higher. Hey, something's wrong, something's changed. The smart money isn't sitting there defending this area anymore. Would we still want to be short anymore? No, right? So it becomes pretty clear as to where we should put our stops. If we get short here and they start to print a full bar in the TT telling us that, hey, they're hitting buy stops beyond value now, it doesn't make sense to be short anymore, right? So again, a lot of information I'm throwing your way here, guys, but at the end of the day, none of it's complicated. It's pretty easy. So those are the TT lines. Second tool we have here are the OA bars. The OA bars are programmed to change color based on who's in control, buyers or sellers. And it not only shows us who's in control, but when that control is shifting, right? So the whole idea is here we're trying to kind of crank the odds in our favor, right? And if we're looking to be a buyer, or let me back up a second, put it another way. If we see maybe red all across the board and a red order flow trend, and now these bars turn red up here in an area where it makes sense to be a seller, you can understand how that's going to equate to opportunity, right? Confluence. A lot of things telling us that the probabilities are high, we're going to see a reaction. Next tool we have here is the Delta Force score. The Delta Force score is an algo that we've programmed that gives us a real-time score on how good of a job the market's doing of either finding buyers on upticks, buy stops and buyers when it's moving higher, or sellers and sell stops as it's moving lower. Very important information. So for example, if I'm looking to be a seller up here, what do I want to see in this Delta Force score? I want to see a lower score. Right? That's telling me ideally that the market's doing not as good of a job here of finding buyers as it was doing over here. Right? So on a very basic level, again, think about that crank like a hand crank. You're cranking the odds in your favor, higher and higher in your favor. If you're looking to be a seller here, right, the trend is down, you have ideal trade location. If these bars started to turn red, if you have a lower Delta Force score, now you have a whole bunch of different information coming together and giving you confirmation. Right? It's all based on the order flow, but it's looking at the order flow from slightly different angles. It's processing a little bit differently. It's looking at it a little bit differently. But yet you have all this different information coming in and telling you the same thing. Probabilities are very high that you're going to get a reaction here. Next tool, the order flow trend tool here. This mark is a little weird to use. Order flow trend tool is telling us who's in control. It's not always going to be the same, but when it's the same, we have two different time frames. This is the 8R, this is the 16R. When it's red, it's a very strong trend. Doesn't mean we can't take a trade if it's white-red or it's white-white. But we're talking in terms of pocket aces. We're talking in terms of what the best type of setup is where we have the highest probability. That's the type of trade that we're going to talk about here today. So in that case, we're going to look for opportunities when this color is exactly the same. So when it's red, we're going to look for sells. When it's blue, we're going to look for buys. Those are pocket aces types of situations. The fifth tool on our dashboard is what we call tilt. Tilt is a little arrow that you're going to see on my screen. In fact, we just had a perfect, another pocket aces type of setup here. Tilt, and again, all this is based on the order flow, guys. This is not based on price. This is an arrow that starts to pop up and will print when the market gets into ideal trade location and is telling us that there's aggressive selling hitting the bid in this area. Very important information. We take that to mean that smart money traders are active here. So again, think about this, guys. If the trend is down, in this case it's down, and I think this was actually from yesterday. I just made this slide yesterday, or maybe even overnight. Yeah, this was last night, overnight. The market comes up into ideal trade location, right? This TT is going to represent ideal trade location. We know that ahead of time. It's not changing, right? It moves very slightly as the market develops. It's not something that is whipping around with price, right? It's very smooth. The trend is down. We already know ahead of time, hey, this is the area where we want to look to be a seller. Now up here, Delta Force score for overnight, a little bit high, 1.0. During the day, you'll see much higher scores because the market's much more active. But you get tilt firing off, and tilt firing off here is telling us, hey, smart money traders are coming in to aggressively sell and hit the bid with market orders. We know they're smart money traders because retail traders usually aren't doing that. Doesn't mean retail traders can't be looking to sell here, but what are they probably looking to do here? They're probably looking to work limit orders. That's the retail trader mindset. You know, I don't want to pay the spread. If I want to get short, I don't want to sell the bid. I want to try and get filled on the offer. Hey, that would be great. That's a good plan if you were always guaranteed of getting filled. But the problem is that you're going to miss a lot of trades, right? If you're always sitting up here with your trade, with your order on the offer, looking to sell, all right, you got trade location correct. But if you're looking to get filled on the offer every time, what's going to happen is you're going to miss some of these moves, right? You're guaranteed of getting filled on all your losers, but then you're going to miss some of your winning trades because you're not going to get filled. That's something that most traders can't overcome. If you have a good trade setup, guys, don't be too worried about paying the spread. Make sure you get filled, because with the way that we trade as it is, we're taking a very little bit of risk here, literally in this situation. You could be risking maybe 4 ticks, 5 ticks, but yet if the trend kicks back in like you're going to see happen more often than not, your reward potential is a lot greater than your risk. Right? That's why losing trades are no big deal. Right? You manage your risk, you know, effectively, correctly. You're going to have losing trades. Don't think for a second that there's any magic system out there, guys, or some magic trader that doesn't have any losing trades. You're going to have losing trades, but the key is you keep those losing trades small. Right? All right. I don't want to get off on too much of a different tangent here, but the whole idea here was to show you this tilt indicator, and it pops up automatically. And it's not a signal, guys, it's just an alert. It's an additional alert. So here, look at the clue here, right? You still have the downtrend. You had this downtrend pretty much all night since the afternoon, right? The market closed all overnight. It's been sellers in control. You're looking to be a seller here. Now, look at how the bars are starting to change here. Here, you still have buyers here. Now, look at how you start to have sellers. You start to have some neutral bars. Lower delta force score, tilt firing off, pretty good situation there. Your odds are pretty high there that you're going to get a reaction in the opposite direction, and that's what you're looking for, right? So that's tilt. In fact, I think I have the aftermath here. Yep, this is the aftermath. And this is basically what you're looking for. You're looking for at least a move down to test that prior swing point or to come in and test the TT there. Trade delta gauge, I'm not going to go through the trade delta gauge today, guys. We'll go through that tomorrow. The TT lines here, and we'll go into this deeper tomorrow. I'm gonna start to talk a little bit faster here, guys. I don't want to run out of time. I want to show you what the ideal setup looks like, and then I want to go back in the live market here and show you, see if we can see a couple things setting up. The TT lines, and this is something I didn't mention before. I did tell you they have a very high probability of reacting, but what I didn't tell you that probability is somewhere in the neighborhood of 73%. 73% of the time, just flat out, the market's going to react at these levels. Now, it's not something I would throw out there too lightly, considering that probably a lot of you are going to join us tomorrow in the trade room, so you're going to see it real time. So I'm not going to sit here and tell you that something's going to happen 73% of the time when you have the ability to join me tomorrow and see if I'm going to be wrong. So right now you have to take that with a leap of faith, but if you join us tomorrow, you'll see that that's correct. So you can understand that if you have something that you can identify where the market's going to react the vast majority of the time, how you can turn around and use that to help you identify, hey, where's a good spot to get in the market, right? Because if it's going to react in an area 73% of the time, and I have a strong trend, and I get short here, and all of a sudden the market doesn't react there, hey, something's different. Maybe the trend is changing, and now they're hitting buy stops. Maybe my short doesn't make sense anymore. But the key is you're taking a very small amount of risk to see that you're wrong. Very, very important. Right? Here's the thing, guys. Here's another important thing to realize, and hopefully you recognize this. Trade location is one of the best risk control tools at your disposal. You have to realize that a trade that is positioned close to an important inflection point, an important structural point, offers you the best risk-reward scenario that you can get, because literally if you have ideal trade location, you're very close to a point where if the market breaks that point, that inflection point, the trade doesn't make sense anymore, you're taking a very small amount of risk where if the market reacts where you expect it to react, it's going to give you a much bigger reward than the amount that you're risking. And that's the key, to skew that risk-reward ratio in your favor. All right, this is an example of the type of inside-out situation that we look for, and then I'm going to break this down with labels and show you this. I want to show you these 3 steps, and then we're going to go to the live screens, and then I'll catch up on all the questions that we missed here. I promise. There's a lot of questions coming in. I want to get to them all. And again, guys, don't forget, email us at support@orderflowedge.com or orderflowedge.com/ Casey, what's the link again? orderflowedge.com/ open room. There you go. So we want to think about the market in terms of it being just a series of stop runs, guys. Stop run after stop run coming in. This is what drives the market all day long, every day. It's all about these trap traders coming in. So, you know, here you have trapped buyers. Here you have trapped sellers. The trapped sellers buying back. Here you have trapped buyers. The trapped buyers sell them to get out of their trade. Here you have traps, and so on and so forth. And what we're doing, again, is using the stop runs to get the market into an area that represents ideal trade location for us. So in this situation here, what we have is a bunch of trapped longs up in here. The HFTs, the Algos, they pick up on the fact that these guys are trapped. There's no more buying coming in. Right? So what they do is they start to sell against them, and immediately these guys feel trapped and they start to sell a little bit. Right? The HFTs want to front run the momentum that's going to come in. So they're selling in front of all the other selling that's going to come in. Now what happens is you get another little uptick here. They can see, you could already see here with the Delta Force score, 2.1, 2.8, a lot lower than it was here. You see a transition here from buyers in control into sellers in control, but yet it's still a buy trend on the higher time frame. Right? So we're going to wait for this stop run to come in, and we're going to wait for all the longs that bought in here to get stopped out. And as that brings the market into ideal trade location, that's where we're looking for opportunity. Now what happens down here? Well, first time down, pretty decent Delta Force score, right? This would be aggressive entering here. I would recommend waiting for the retest. When you get that retest, that's when you're going to look for that lower Delta Force score. We think in terms of stop run over, retest. And it's on that retest that you should get the order flow clues. Looking to kind of step in front of this stop run that comes in right here. We know our ideal trade location. We know where the market's likely going to bounce, but it's still a little bit more riskier than waiting for the clues. And here's the clue, lower Delta Force score. All right, so now what's going to happen down here? Anybody that sells down here is going to get trapped, and now their buying is going to kick the trend back in. Now, not only do you have these sellers stepping in to buy here, you have smart money traders that are looking at this area as value. They're sitting here waiting to buy too. Right? So you get a lot of buying that's starting to come in here, and that's what's going to kick the market back into the trend. And that's what's going to happen more often than not. It's not going to happen every single time, but it's going to happen more often than not. All right, so you get the stop run against trap longs, exhaustion, stop run over. You get a move back in the direction of the underlying order flow trend, and that cycle just keeps repeating itself, and that's what you look to identify in the market. This stop run over situation, this cycle is what we look for, and it's kind of like wax on, wax off with Karate Kid. I hope probably a lot of you have seen that movie. I'm probably dating myself a little bit here. I actually went to high school with Ralph Macchio. But stop run over, retest, this is what we look for. And here's an example here too. I'm kind of taking this out of context, but you see here how the market's kind of hitting stops. It's hitting buy stops. Delta Force score 4.0, 4.1, it's increasing. It's telling us, hey, the market's doing a good job of finding buyers. We don't want to get short in here. It could stop anywhere. It could stop here. It could stop here. Now all of a sudden, boom, Delta Force score is starting to lower. We can see that real time. It's still risky to sell here because technically they're still in stop run mode, but look at this stop run over out of the TT, and look at the retest. Look at the transition here now. Now you've gone from blue bars to red bars. Now you've gone to high Delta Force score to lower Delta Force score. Right? Stop run over, retest. This is where we're looking for the trend to kick back in. Right? It's very, once you start to look for this cycle in the market, you condition yourself. It's very easy to see. In fact, this is something that you could take and even apply to whatever type of trading that you're looking for. Just think in terms of that first move that comes in is about stops getting hit. And then you get some new sellers coming in, and then those new sellers get stopped out most of the time. But the point is, they can't find those higher time frame stops anymore. Right? The higher time frame stops is what got the market up to this point, and then it's like the faucet's turned off. There's no more buying coming in. So the market falls out of stop run mode. Most of the time they're going to test again. On that test is where you look for clues to enter. Right? You don't really want to step in front of the first stop run. That's a little bit risky. You're looking to step in front of that stop run over test. Same thing here. Right? And this is a pretty cool example. This is happening in sub-second time frame. Some type of news came out. But you can see even here how quickly you can disseminate this information. Not that we're looking to trade when news is coming out, but just as an example. Stop run, right? Stops are getting hit. They're in the TT stops. Look at this, 5.6. Market's doing a great job of finding sellers here. And then all of a sudden, boom, stop run over. Retest. Look at the score here, how quickly it dropped, 0.3, 0.1. It's telling you right in front of you that the market's no longer finding any aggressive sellers here. They're not finding stops anymore. Not only that, look at the buying coming in. So you got exactly what you're looking for here. You have the selling exhausting, and you have buyers coming in. You can't find two better things. I can't think of two better things that I'd like to see if I'm looking for a trade. All right, so I'm going to go through these two slides here. We already covered the inside out and outside in, and we'll go into that a little bit quicker tomorrow, a little bit deeper tomorrow. But the inside out trade, let's break this down step by step. These are the 3 steps. Step 1, determine our bias. We're using the order flow control bars here to tell us what the trend is on the order flow. And remember, this is not price trend. This is the order flow trend. This is telling us what the higher time frame traders are doing. Where are they more aggressive? They're more aggressive here to the buy side. Step 2, identify ideal trade location. Here, the TT lines automatically show us where to enter. Now, we have other clues that we could look for. We have deeper levels of information. We have a pocket of trapped sellers here, which happens to line up with the same area. There's other, it's kind of like almost like an onion where you peel it back and there's another layer there. It's the same thing here with information. I'm just explaining all the basic level information, but the more that you start to use this information, the more you start to realize that there's a lot of information, useful information that you can take from the order flow. And it really explains why things are happening in the market. It really kind of blows your mind when you look at this stuff and you realize, hey, this information has been here the whole time, but yet I've never thought about the market in these terms. Hey, if there's trapped sellers here and they didn't stop themselves out up here, what do you think they're going to do when the market comes back down here, guys? Anybody think if you're a trapped seller and now the market comes back to the level where you were trapped, besides, first of all, you're thanking your lucky stars, right? But after you're done thanking your lucky stars, what are you doing? You're buying them back. You're thankful for the opportunity to scratch out, right? So can you understand how that's going to help to add to the buyers that are coming in here, right? It all kind of builds. It all comes together, and you're thinking, hey, you know what? This is a really high probability spot to get a reaction here. And that's what we're looking for. That's what it comes down to, right? Step 3, we enter with order flow confirmation. Here we have blue OA bars and a lower delta force score, right? Doesn't get much better than that. Here's an example to the sell side. Order flow trend is down. We get a push up into the TT lines, right? We know that's ideal trade location. They're here way before the market even gets here. First push up, we already see the delta force score decreasing, so you could say, all right, you know what? Let me put some of my position on here. This way, I don't risk missing the trade in case they don't give me that retest. But you'll be astonished at how often the market is kind enough to say, all right, you know what? You're looking at this area. Let me give you that extra retest here to get aboard, right? And look what happens on this retest. Red bars. Look at the lower delta force scores: 1.7, 0.1, 1.0. This transition is occurring right in front of your eyes. It occurs over a time, and it doesn't always work like, over a span of 5 minutes, but look at all the time here you could have had to get short. The whole while, you know exactly where your stop out point is, right about here. So if you're selling anywhere in here, you're risking 4 or 5 ticks at the most, and if the trend kicks back in, your potential reward's going to be a lot bigger than that. You're hearing some alerts in the background. I apologize. The market's kind of moving pretty good in here. Right, so you have your clues, confirmation, and the trend continues down, and that's what you're looking for in those situations. All right, let's get to the real screens here. Let me get back to current market activity because I just saw something on my other screen here, which was really just a great example of the type of opportunity we look for right here. And listen, guys, here's another misconception about the market. People think that there's some magic trader out there and they're trading every swing in the market. They're getting long here, they're shorting here, they're getting long here. We're not looking to do that. I'm not looking to trade every single swing in the market. I want to trade in those situations where I have an abundance of clues, where I have good cause to take a trade, right? Here's the situation. Sellers in control. You got the uptick. First push up, you could see the Delta Force score increasing, right? 1.9. If you were watching this real time, you would have seen this was bigger than this. That would have stopped you from putting on a trade here. But even if you did put on a trade here and you stopped yourself out, not the end of the world. You know, if you put your trade on over here, you take a little bit of risk to see that you're wrong or that they're still hitting buy stops, no problem. Because the market actually gets you right back in, right in the area where you stopped yourself out, right? It gives you that opportunity, and this is where the conservative setup is. Look at all the clues up here. All right, stop run over, now they can't get back in. Sellers in control. You got gradually lower Delta Force scores here, right? 2.8, 1.7, 1.2. Look at the tilt firing off here. All right, what's the tilt telling us? Hey, we have aggressive smart money traders hitting the bid here. So you look at this whole combination of stuff you have here. There's just a preponderance of evidence here, right? You have a lack of buying. The buying is exhausting. You have a pickup in aggressive sellers hitting the bid. And again, that's telling you that smart money traders are hitting the bid up here. And you have control transitioning back to sellers here. Again, you can't hope for, I mean, this is pure pocket aces type of trade, guys. This is a pocket aces type of setup. Doesn't get much better than that. Yeah, they give a little bit of a retest, but look at on the retest, 1.0. Still not real aggressive buying coming in, and you know, your stops in the TT. And if you're scalping, you would have already booked profit. It depends on, you know, it's all relative. You're looking for a scalp, you're looking for the trend to kick back in, you're looking for a retest of this previous low, you could do that too. Look at how easy it is for the market to start to hit stops again to the sell side. Look at the increasing Delta Force score here. 0.7, 1.1, 2.7, 2.8. And now look at tilt firing off down here. That could be an alert for you to take profit. Right? They're hitting stops. If you're still holding runners, maybe you were going for the next TT. Where's my next level of demand? Here. Right? Maybe that'll be my target. You know, oh, we're down there, and now I'm starting to see tilt fire off. Let me buy them back. Right? Hopefully that makes sense, guys. If any questions about this, let me know. Let me try and catch up on some questions here. We've gone a little bit neutral here right now in real time. But look at again how tilt is firing. Tilt fired off here, nice little downtick. Tilt fired off here, nice little downtick. Again, it's not a signal. It's more of an alert. Right? It's telling you, hey, you know what? Aggressive buyers are coming in. All right, Casey, I hear you. No problem. Go ahead. Telling you aggressive buyers are coming in an area where it makes sense to be a buyer. Right? That's what it comes down to. Let me look at, let me see if I can give you a couple of other examples here. Here's one on another screen I'm just going to pull down. Gold. This just happened a few minutes ago. The trend is down. You have to take my word for it. I can't pull down these two charts as well here, but the trend is down here. Right? First push up, they're doing a pretty decent job of finding buyers. Stop run over, retest. Look at the clues here. Lower Delta Force score, red bars. Nice sell-off. And I think there was actually a good opportunity a little bit earlier in gold as well. Right before 9 o'clock, I was watching gold. Let's see. Yep. Actually right here. Looking. This is pocket aces. We were red here. Might be a little hard for you to see these numbers, but 14.9, 6.1, 5.0, red bars, tilt firing off, a combination of everything going on here, right? Good thing, Richard. Join us tomorrow in the room, and we'll show you real time what's happening. Have a great day, man. So that's gold. I know a couple of you are asking about crude. Let me see if I could pull crude down here real quick. Really haven't been watching crude here too much this morning. Actually, crude is right here. We have crude here too as well. This was from yesterday afternoon, type of situation that we look for. Buyers in control, right? You got blue bars, you got tilt firing off here. Trend kicks back in. Let's get back to real time here on crude. Sellers are in control here right now, guys. It's starting to turn a little bit neutral to sellers in control. I would look to be a seller on any pushback up in here. You know, and listen, here's the thing. It's not like, hey, you got to wait for the market to get exactly up here, but just know you could sell anywhere in here, but this is going to be your stop out point. All right, this is ideal trade location. The ideal trade location equates to the spot where you're taking the least amount of risk before you know that you're wrong. And listen, we know that they're only getting into the TT if they're hitting stops. And if you get short right here and they start to hit buy stops in here, why would you want to be short anymore? You'd want to know that as soon as possible. Right? That's the whole idea, control your risk. You're taking a small amount of risk. You know, the way that I think about it is that you're paying for information. That's what it comes down to. And if they're hitting buy stops, but you get the idea here, even in terms of, here's another one right here, guys. This was right about 10 o'clock in crude. Sellers in control, right? First push up. They're doing a pretty decent job of finding buyers, but you got some aggressive sellers coming in, and what does that tell you? This is a little bit more, this is a little bit deeper, and we teach the stuff, we talk in these terms, so you get to understand this. When the market makes a high on a pretty decent delta force score here, what's that telling you? It's telling you that the market was doing a really good job of finding buyers here, but what happened to those buyers? They got trapped. They ran into a brick wall. Smart money traders, look at the tilt coming in. So as you got people getting stopped out of shorts here, as you get people buying here because they think it's a good idea to be a buyer, you have a bunch of smart money traders coming in here and hitting the bid, selling. Right? You see where tilt comes in here? And you get this nice little downtick. And then you get the retest, right? So it's kind of like stop run over retest. Look at the retest. If you didn't get short here, which, again, I don't usually advocate selling into a higher delta force score, even though it can turn into trap buyers. It's a little bit more complex, it's a little bit more trickier to do that, a little bit more riskier. I advocate the conservative way to trade is to wait for the retest and look for the clues on the retest. 11.1, they can't get back into the TT. Again, we think in terms of where's the next logical spot to be a seller, it's going to be at this TT. And on a very basic level, as long as they can't break into the TT, shorts make sense. And if they do break into the TT with a full bar, that means they're hitting stops and the short doesn't make sense anymore. Right? It's pretty simple. We have guys, and they're a little bit more aggressive, you know, that will take the trade here for the short no matter what, but if they're not getting, you know, the types of clues they want to see, they're just going to take it with smaller size because they know that they still have a very high probability of at least seeing a reaction here. Right? If they have better clues, then they're going to size up and they'll put on a bigger trade. Right? Those are pretty. This is a pretty good situation here, 11.1 compared to 26.9, and the trend kicks back in, and that's what you look for to happen. Right? Again, I really didn't look at crude too much here, so I don't want to scroll back too much here in front of your eyes. Well, Yogi, great question. Very interesting, but do I consider volume at all? Yogi, this is all volume. Right? But think about the type of volume it is. It's parsed volume. Right? So here I am. I'm looking at order flow. I'm looking at aggressive selling hitting the bid and aggressive buying hitting the offer. But guess what? If you add that together, if I have if I have in this 2-tick bar here, for example, I'm just going to give you an out of context example. Let's say in this bar that's happening right here, right now, I have 600 aggressive sellers hitting the bid and 400 aggressive buyers hitting the offer. Guess what that adds up to? 1,000, right? But that's not the answer I'm looking for. That adds up to the volume that took place in the bar. Right? So how and listen, I went down this route initially. I looked at pure volume. It was one of the first things I came upon, but I wasn't getting enough of a clue as to what was going on. It didn't give me an edge. Because what happens is sometimes you get a big volume burst coming in, and say you get a big burst of volume here. What does that mean? Does that mean the market's going to top out, or does that mean that it's going to continue? Right? That's the issue. Now, if you get a big burst of volume here and you're looking and you're saying, hey, big burst of volume, but I saw 700 hitting the bid and 300 buyers hitting the offer, now that's a different story. Right? It's kind of like you're lifting the hood and looking underneath at the engine. You know, you're looking underneath the surface and understanding what's happening here. You know, there's more information to understand, guys, but it's not complicated. Exactly, Yogi. We're looking at the imbalances, and not only that, we're looking at the imbalances that occur up into important areas of supply, sellers in important areas of demand, which represent wholesale and retail, which is the way that you should be looking to do business, right? You got it, Yogi. Can I show oil? Yep, I just showed oil there, Mark. If you join us tomorrow, I'll be a lot less rushed. We'll take our time. I'll show you any chart that you want to see tomorrow. Do we use it on equities? Yeah, I trade equities on much higher time frames, Dwayne, but it's the same idea. Any stock that you want to trade, I can show you how, what the effective range would be that you should use based on whether you're a swing trader or a scalper. It's all relative. For crude oil, the settings are a little bit different. I'm not looking to be, such a scalper as I am in the S&Ps. But, there's two ways that we do it. We have a screen share room where we share my screens, and I have a room where I actually share all the different screens. I have different futures that you could see, or you have the ability to run it on your own screen through Sierra charts, where you could change the time frames. You could do it on whatever market you want. That's up to you. I try not to Lewis trade the CL report. I'm not a super active CL trader. What I like to do is really wait for pocket aces types of situations. I'm not looking to fade the trend in CL, where in ES I don't mind stepping in and looking to fade the trend if I have a good reason to. Especially when my inventory levels are getting hit on higher time frames, cumulative delta levels. I don't have time to go deep into this today, but we'll go into this tomorrow in deeper detail. Signals, Scott, I don't know, I'm not crazy about that word signal. It's more of an alert of conditions that are happening that are telling you, hey, you know what, if you're looking for a short, you have optimum conditions and ideal trade location to put your short on, or vice versa. So I'm not a trade calling service per se. I'm not providing signals. I'm teaching people how to find this stuff on their own, because there's just so many markets out there, But I'm a big currency trader. I trade currencies on higher time frames. I talk about swing trades when I'm taking them in the room. I'll tell people, I'm looking, we were talking about the euro yesterday. For longs, I'm looking for a big swing to the long side in euro to come in. I forget what my last swing was. British pound was a huge swing, but in currencies, I could be in a trade in currencies for weeks or a month. I'm a swing trader on much higher time frames. Can I show the Russell? I don't have the Russell on this machine. I have about 10 screens here on 3 different machines. I have the Russell on another machine. We actually share a screen, which is pretty interesting. We call it our equity strip. And again, you could run it on your own machine. We have someone that kills it in Russell every single day. And I don't look at the Russell too closely, but he swears by the tilt on the Russell on all the different time frames. When he has tilt firing off across the board, it's a very high probability situation. But we use what I call an equity strip, where I have the ES right next to the Dow, right next to the NQ, right next to the Russell, so I could see what all the different equity futures are doing at the same time, and that provides information too. I can't right now, Yogi, because I'm about to run out of time here, and I don't want to cut into anybody else's time. But if you join us tomorrow, I'll be more than happy to show you an example of equity. Where do I get my order flow information from? Right from my data. This data on this screen is from IQ, DTN IQ. And on my other machine, I like redundancy, so on my other machine I use real-time data right through Sierra charts, and it's exactly the same. It blows my mind as to how close the data is. All these delta flow scores, which are very intricate, it's an intricate combination of values to come up with these scores. They're exactly the same on both of my screens. And that tells you that the data is spot on, right? So I have 2 separate data sources, both giving me perfect real-time order flow data. How to trade. Bob, we'll go through the divergences tomorrow in the cum delta, but there's 2 different main ways to trade cumulative delta. One is the inventory transitions that come in that show us the exhaustion that comes in on the stop runs, and the other is more of what we call a commitment situation, where you have a perfect example right here. You see these pushes up here overnight, and I talked about this yesterday at the close, and again, I mean, believe me or not, I mean, if you join us tomorrow, you'll have a better idea that, you know, I'm not really about blowing smoke anybody's way. There's no need to. But we talked about this yesterday at the close of the trading room yesterday, of looking to be a seller in any uptick into this area. Now look at what happened overnight on this uptick, on this uptick. Look at the cumulative delta here, showing that all these shorts that came in yesterday at the close did not buy them back up in here. So showing a major lack of demand here. And here we are, you know, 16, 15 points lower. It's not a coincidence. There's a reason.
Yes,
so cumulative delta is big. It's all about stops getting hit. And right now what we're doing is they're trying to push into yesterday's lower level. This is going to be a spot here to look for a reaction. All right, let me show that link again. I will. Dan, sorry, I went over a minute here. Let me give you that link again for tomorrow, guys, and we'll go into this much deeper tomorrow. But listen, if what we talked about today resonates with you guys, then you're going to be, you know, super interested in what we'll talk about tomorrow, and maybe even possibly joining our community. If you're looking for some, you know, red light, green light magic system, that's not what we're about. We're about understanding, you know, teaching what's going on in the market so you can understand. And, you know, I'll show you the alerts that we use, and you can have them on your own screens as well, and you can understand how to use them. So if what we talked about here today made sense to you on any level and you want to learn more, feel free to join us tomorrow. That's the link. You got it, Yogi. My pleasure. And I'm sorry if I wasn't able to. If I missed any questions, I promise I'll get to them tomorrow. Thanks a lot, Dan, for having us. Thank you, everybody, for showing up here today on a